finally, we get to market averages and indexes, even though we've been using them for the entire semester so far. Look, we've got to be able to measure how well we're doing, how the stock market as a whole is doing, and how well we do uh, relative to various parts of the stock market. And that's where these things come in. Benchmarks, standards, averages, indexes. How can we say on slide 47 that stocks have returned approximately 10% over the past 90, 100 years? Well, the industry uses market averages, market indexes. These are benchmarks used to measure the general behavior of securities prices by reflecting either an average price behavior, that's a market average, or a relational price behavior, that's a market index, of representative groups of securities at any given point in time. And of course, we're discussing stocks, but there are averages for bonds and other types of securities, other types of financial investments. You can't help but hear about these things every day in the news. The Dow went down, the Nasdaq went up. What are you talking about? And what are points? Points? What are points anyway? Things that you that are at the end of the stick that you poke somebody in the eye? Yeah, points are meaningless. It's the percentage changes that are important, in my humble opinion. And I wish they wouldn't even mention the word point. The Dow went up a percent. The Nasdaq went down a percent. That's what they need to discuss. And at the bottom of the slide, we see that the differences between a market average and a market index are subtle, not that important, and most people don't even know that there are differences between the two. Slide number 48. You see, a market average just looks solely at the price of the stock without regard to its market value, without regard to its capitalization, how big the company is. Remember, large cap, mid cap, small cap. We'll delve into those later on in this chapter. And the most important one is the Dow Jones Industrial Average. And then there's the Dow Jones Transport, Dow Jones Utilities, but that's it. There's not really that many market averages that we need to worry about. All the other standards are market indexes. Those are market weighted calculations. In other words, they take into account the value of the company in the index. And the larger the company, the larger the market share, the more influence the security will have in the index. And the most popular one is the Standard & Poor's 500 stock index, the 500 largest companies based in the United States. And market-weighted calculations were generally regarded as a better measure until the bubble of the late 1990s, and then the bubble. It wasn't really a bubble, but when financial companies took a huge portion of the Standard & Poor's 500 in the mid-2000s. And then lately, before 2022, we had growth companies that made up 30% of the Standard & Poor's 5. So what happens is eventually, or not eventually, but every once in a while, a certain industry or sector of the economy gets skewed and makes up a huger portion of the index. Because what happens? The bigger the company, the more influence the company has in the index, especially when it's going up. And so the index goes up and people put more money in the index using index funds. And that pumps up the price of the companies, which makes the index go higher. And it does the same thing on the downside. And we'll get more into that later on. But we already discussed that a little bit in chapter 2. So let's take a look at the most important indices. Folks, I have a hard time believing this, but there are thousands of these things. It's just ridiculous. It's just absolutely ridiculous. So we're going to ask you to internalize 8. And there's the stock worksheet number 1. And we're going to want you to memorize these, right? Internalize is a fancy word for got to remember them. The most popular one, and one of the worst, in my humble opinion, is the Dow Jones Industrial Average. This is a stock market average made up of 30 high quality stocks selected for total market value and broad public ownership and believed to reflect overall market activity. Don't believe them. It's only 30 stocks. It's not a good index, an average actually, not a good benchmark, in my humble opinion. Because if one company, because there's only 30 companies, if one company does really well or does really poorly, it skews, there's that word again, it affects the index much more than if you have 500 companies. But then again, when you have 500 companies and 10 of them make up 30 of the index, the same thing happens with they're not perfect, right? Nothing's perfect. This is the most famous one. It's been around since 1896, right? And it changes from time to time as companies and industries evolve. And as such, there are actually few industrial stocks left in the index. Most of them are non-industrial stocks. But that doesn't matter. It's the most popular. It's the one you're going to hear every day on the news. Dow Jones is the company that publishes the Wall Street Journal. In 2007, Rupert Murdoch of Fox News fame wanted this company. Well, he wanted it before that, but he made an offer in 2007 of about $5 billion. Most people, it was privately held. Most people felt that Dow Jones was worth about $3 billion. And the famed Bancroft family owned most of the company. And many of them didn't want to sell to Fox News because of their penchant for lying. They're in deep kimchi as of this discussion with their assertions that the 2020 election was fraudulent when it wasn't, and they defamed a certain very small company that made voting equipment and said that Jewish space lasers from Peru or something like that. Anyway, many of the people didn't want to sell to this company because of their tarnished reputation, but they were offering almost twice as much as so the rest of the family said, come on, let's sell. And then what they did is they turned around. I think they either sold or licensed or whatever. So now all the Dow Jones averages are being run by Standard & Poor's, the Standard & Poor's 500. So figure that one out. If you can figure it out, go look on their website and see that it says something along the lines that, oh, Dow Jones is no longer really doing this. It's actually Standard & Poor's, but they still call it the Dow Jones Industrial Average. And here they are, dear students. Here are the 30 stocks of the Dow Jones Industrial Average as of early 2023. Most of these companies you've heard of, right? American Excuse. Who's Amgen? That's a biotech company. Apple, of course. Boeing, the airliner. Caterpillar, what do they make? Right? Tractors and earth-moving equipment. Chevron. They took out Exxon recently. I don't know why. Cisco makes the internet equipment. Coca-Cola, Disney, Dow is a chemical company, not Dow Jones. No, it's a different company. Goldman Sachs, Goldman Sachs, an investment bank, not the kind of bank you think of, but these are some of the people who bring companies public for other companies. Yeah, that's their job. Home Depot, Honeywell. What does Honeywell make? Oh, lots of industrial devices such as thermostats. IBM, the computer company. Intel, the chip processor. Johnson & Johnson, which is supposedly breaking itself up into two. JP Morgan Chase, the bank, and other financial services. McDonald's. There was a movement there for a while to call McDonald's a manufacturing company. Well, they make burgers. Merck is a drug company. Microsoft, the software company. Nike. Procter & Gamble. What does Procter & Gamble make? Interesting. Yeah, you know them because they make Tide and Head and Shoulders and Pampers and Gillette razors and dozens, Crest toothpaste, dozens of consumer products. Salesforce. Now, it's supposed to be lowercase. I don't know why, but I made it uppercase. They're the company that they kicked Exxon out to put Salesforce in. What do they do? Look it up. It's called CRM, and I'm not exactly sure what corporate resource management, I think, is what it stands for. I don't think they're worth it. But I'm not the one making the decision. 3M, Minnesota Mining and Materials. Right. You ever hear Post-it notes or Scotch tape? Travelers Insurance, United Healthcare Insurance, Verizon. They kicked out AT&T. Visa Squeezia, Walgreens Boots. What? Walgreens is the drug company, right? The drugstore chain. They did what's called a corporate inversion, where they sort of sold themselves, but not really, to a small Canadian company that made boots. So now they're actually a Canadian company, but they really aren't. And then Walmart. So most of these companies you've heard of, right? And you'll hear people say, wow, look what happened to the Dow. It's where it was 5 years ago or 10 years ago or 20. No, it doesn't work that way, because they keep pulling out companies and putting in new companies. And so the Dow is not what it was 20 years ago or 10 years ago or whatever, because it wasn't the same index. And it's only 30 stocks. So on the website and in the face-to-face class now, we would do the cute little instrument where we say, we're going to give you $10,000 88 years ago. Try it. See what you think, okay? It's kind of fun. Okay, so Dow Jones also created several other indices. And for decades, the three big ones were the Dow Jones Industrial Average, the Transport Average, and the Utilities Average. Actually, the Transport is actually older than the Dow Jones Industrial Average. And many people do look at the Transport Average because they look at the transportation sector as a proxy, as a leading indicator for what's going on with the economy. Because before stuff can be made, it's got to get there. And then after it's made and can be bought, it has to get to where it's going to be sold. So some people look at the transport average. The utilities average, obviously just for utilities, not that important. And then you put all three together and you get the Dow Jones 65 stocks composite average. Well, those three that on the top, we're not interested in. But the next two are actually kind of important. And we want you to remember these next two. The Dow Jones U.S. Total Stock Market Index. What a stupid name! It used to be called the Wilshire 5000. Wilshire is a company that is another research company, and they made the 5,000 index, Wilshire 5000. And what they wanted to do is they wanted to see how big companies were doing, medium-sized companies, and small companies. So they made an index of some 5,000. Well, it bounces around. At one time it was 7,000. Now I think it's down to 3,800 or whatever. But Dow Jones, some pulled a fast one on them. Somehow they sort of got together with them and called it the Dow Jones Wilshire 5000. And then they kicked them to the side of the road and got rid of them. And now they call it the Dow Jones U.S. Total Stock Market Index. And of course, you're all going to remember that. Just be able to identify it. Why? Because many index funds that we talked about in Chapter 2 use the Dow Jones U.S. Total Stock Market Index. I wish they still called it the Wilshire 5000 as their benchmark. They use I don't think they buy all the companies, but they randomly buy many of the companies in the index. And then the next one should look a little familiar to those of you who did the thrift savings plan, the Dow Jones U.S. Completion Total Stock Market Index. And everyone's going to remember that. I can't remember it. I keep forgetting it. I still call it the Wilshire 4500. What did Wilshire do? They took the Wilshire 5000, which is the 5,000 companies in the United States, and then pulled out the top 500 companies that are in the S&P 500, because the S&P 500 is the top 500 companies. So they pulled them out. And what do you get? You get medium-sized and small-sized companies. And this is the index that the S fund in your, that's one of your answers to one of your questions. If you haven't done the assignment for Chapter 2 yet, now I just gave you one of the answers. That's the S fund. And they are saying, this is what's going to happen. This is what's going on with the mid-size and the small companies. Now, the last one is a very interesting index. It shows you why you should stay away from indexes in general, especially those that are not broadly based, like the Standard & Poor's 500 or the Wilshire 5000. As the internet bubble was expanding in the late 1990s. Oh, it was a long time ago. The Dow Jones created the Internet Index. It went on to lose 94, I think, or 95%, or maybe 96%, one of those three. I can't remember exactly which one. A whole lot of money. It went on to basically collapse over the next few years. Yeah, so just because you think you're getting an index, you're getting it broadly, and not necessarily. And with thousands of these things, it's only a matter of time before several of them just crack and dissolve into a pool of tears. Okay, so those are the Dow, even though they're not run by the Dow anymore. They're now run by this company, Standard & Poor's, which has been around forever and the most popular one, and I think the much better than the Dow Jones, in my humble opinion, and whatever that's worth, is the Standard & Poor's 500. 500 stocks chosen for market size, liquidity, and industry group representation. It is an index, meaning it is market weighted. Traditionally, this was the largest 500 companies based in the United States. Now, what happened for a while there? Some companies, such as Arco, right? I remember the name of it, Arco, AMPM Markets. They were bought by foreign companies, British Petroleum. And then Chrysler was purchased by Daimler-Benz, Mercedes-Benz. So S&P said, what do we do with this? So for a while there, they let some foreign companies, which own substantial U.S. companies, in the index, but no more. They don't do that anymore. As we said, it's very popular and used by many, 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 many index funds. Because the Standard & Poor's 500 is market weighted, it was affected by the internet bubble of the late 1990s in a bizarre manner. The market values of a small percentage of technology companies were inflated to extremes. Sound familiar? This skewed the index even more toward those companies because the index fund manager has no choice, has to buy the shares of the companies according to their weight in the index. So as the company becomes worth more, they have to buy more shares, which incidentally makes the price go up, which creates this feedback mechanism, like a spiral upward. In 1998, 10% of the gain of the S&P 500 was due to one stock. That was Microsoft. This same phenomenon is currently in play with the top 10 companies having an outsized influence on the index, but much less than it was before 2022, where some companies were in the $2 trillion range, Apple, Microsoft, and some of them were in the $1 trillion range, Amazon, Google, but a lot of the air has come out of the bubble, but not all air, in my humble opinion. I still think some of these high flyers, as they call, are fallen angels, but some of them have face planted, like faceplant. I mean, I'm sorry, Facebook, Facebook, Meta, and look at what happened to Netflix. Oh my goodness! So check it out. Just because it's a broadly based index doesn't mean it's broadly based, because some companies can have a huge impact. I mean, think about it, folks. One company out of 500 made up 10% of the return. Yeah. 10 companies make up 30% of the index. 50 companies make up 50% of the index. Maybe we should call it the S&P 10 or the S&P 50. Slide number 53. Standard & Poor's has thousands of averages and indexes, folks. And you're not interested in most of them, and the ones on 53, I'm not going to ask you to remember, but you can remember that there are thousands of them, and a few of them are the Industrial 400, the Mid-Cap 400, the Small Cap 600. Put together the S&P 500, the S&P Mid-Cap 400, the S&P Small Cap 600, and you get the S&P 1500. You add it up, it's 1500. And then there are transportation, utilities, financials, global, international, sector indices, thousands of these things, folks. And people are buying and selling index funds, either regular index funds or exchange-traded index funds, based on these indices. I wish them a lot of luck. Now, those were the Standard & Poor's, and we said there are thousands of them, but the only one you have to remember is the S&P 500. Now, on slide number 54, we see 4 indices, but really the only one that you really hear that much about is the NASDAQ Composite Index, sometimes called the Tech Index. There's a New York Stock Exchange Composite Index, the Amex, New York Stock Exchange Amex Composite Index. I think that's what it's called. And the NASDAQ 100 Index. But you don't hear too much about them. The one you hear the most about is the NASDAQ Composite Index. And because that skews towards technology, because the largest companies are tech companies, and of course a larger company has more sway in the index. So you'll hear the S&P and the Dow went down, but the NASDAQ went up. So that meant that the tech sector did really well, whereas the rest of the world sort of just didn't do as well. And this is how volatile, fancy word for I lost a lot of money, the NASDAQ is. It went from 800 in 1995 to 2,000 in the year 2000. Just unbelievable. It then dropped 80% between March of 2000 to October 2002. The NASDAQ index is technology laden. Excuse me. So I want you to remember that one too. The NASDAQ the tech market index. Now, we've already made mention of these two folks because why? They're very important for, especially if you have a thrift savings plan account. The U.S. Total Stock Market Index and the U.S. Completions Total Stock Market Index, I still think of them as the Wilshire 5000, the Wilshire 4500, but Standard & Poor's has their own, MSCI, Morgan Stanley, Capital International, we'll take a look at them in a bit. But the ones you're going to hear the most about, and I hate the names, are the Dow Jones U.S. Total Stock Market Index and the Dow Jones U.S. Completion Stock Market Index. I still call them the Wilshire 5000 and the Wilshire 4500. But small companies? Well, the Wilshire 4500 was meant to do medium-sized and small companies, but before the Wilshire 4500 came out, Frank Russell Associates had their own index called the Russell 2000, and this is the one you'll hear about in the news more often than the Wilshire 4500. And you don't hear that much about it in the news that much, unless there's something going on in the small company sector. This was meant to measure the small company performance. So what did they do? It's actually kind of tricky what they did. They created the top 1,000 companies by size, and then created the top 3,000 companies by size, and out of the 3,000, they pulled out the top 1,000. You see what they did? They hollowed out the top. I shouldn't say hollowed out. They just kind of lopped off the top 1,000. So the Russell 2000 has the 1,001st company all the way down to the 3,000th company. And that's meant to measure small company performance in the United States. You got it? So far we've got the Dow, the S&P 500, the NASDAQ, and we've got the Wilshire 5000, the Wilshire 4500, which the Wilshire 5000 is the Dow Jones U.S. Total Stock Market Index. I remembered it! And then the Wilshire 4500 is the Dow Jones Completion Total Stock Market Index. I forgot it. Now we're going to, and we have the Russell 2000, so we have 6, right? Okay, 6. Well, all of those 6 are basically United States measurements. And of course, they're most popular here in the United States. But what if we want to measure how we're doing outside the United States? Well, this was a conundrum that some of the mutual fund companies had back in the 60s and 70s, 1960s and 1970s, when they started to invest overseas. Well, one such company, American Funds, which is actually called Capital, decided they needed an index. So they created a subsidiary called Capital International to develop two, actually they developed more, but the two big ones were the World Index, which was the global index. Remember, global means everyone outside and inside the United States. And they created the EFA. Don't ask me why they call it. Some people call it EFI, but most people call it EFA. Europe, Australia, and the Far East. And then they thought, this isn't a good idea. Here we are creating the index to measure ourselves by. Obviously, conflict of interest. So they sold off Capital International to Morgan Stanley, and that's why you see MSCI. Now, most people have no idea that MSCI stands for Morgan Stanley Capital International, but it's a cute trivia. And these were for many years the benchmarks that we use for global mutual funds and international mutual funds. Well, there was a problem. In the 1980s, 1990s, and the 2000s, the developing world, the emerging markets started to do fairly well. Some have done very well, but they're extremely volatile. Sometimes they're called the submerging markets. And instead of just adding those companies and those countries to the World Index and the EFA, they created two new indices. Now, again, they didn't ask me. If I would have talked to them, I would have said, don't use this name, but they did. The MSCI All Country World Index, which is replacing the World Index, because the World Index doesn't have China and Latin America and Eastern Europe and Africa and South Asia. They just don't have it. They keep the United States, Western Europe, Canada, South Africa, Singapore, Hong Kong, Australia, and Japan. And so for the EFA, for the international, they used MSCI All Country World X USA. I think it's dumb. I think it's a dumb name and it's hard to remember, but hey, that's what you're up against. Now, in the face-to-face class, we would stop and do worksheet number 1 because that's what worksheet number 1 pertains itself. It wants you to memorize, internalize, know the 8 important indices, realizing that there are thousands of these things, folks. Okay, so maybe you want to stop now or after we're done, because we've only got a few more slides left, so stick with us, okay? Cool, okay. So where are we now? Slide 57. Oh no! Or you turn on the news, or you watch TV, or you go on the internet and you see today's unstable stock market index mania. My goodness, dear friends, the Dow zoomed ahead in the morning up to noon, in which then there was a plummeting fall of almost 23 points, and then it came back and ended pretty much where it started at the beginning of the day. This is what you're going to see on the news. But you know what? This is bogus. Back in the early 1950s, there was a wonderful book. The numbers are all wrong, but it's called How to Lie with Statistics. And it's a wonderful, darling little book, folks. I know you don't like books, but books are cool. They're better than the television set. The pictures are better in your head. I'm not talking about graphic novels. And this is one of the ways to lie with statistics. See what they're doing? They're only showing us between 34,075 and 39,099. That's all they're showing. Not showing us the whole picture. If they showed us the whole picture, this is what it would look like. Stock market index ennui. You like that word? Ennui. It's a French word. It's in the English language, but it means beyond boredom. You think you're going to die of boredom, but most people, when they die of ennui. Today's stable stock market. Are you going to see this on the news? No, you're not going to see this in the news, nor will you see this graph. Because if you remember when we took a look at volatility in our first presentation for Chapter 3 stocks, we showed how gut-wrenching the market movements were in 2022. But if we show the whole darn thing from 0 to 10,000, it really isn't that bad. But you're not going to see this graph on the nightly news. And I just absolutely adore showing this to people face to face, because you can see, literally, I've seen it, you can see students' faces just relax when they realize that, okay, not so bad, I can deal with this. They're so worried, and that's good. I'm glad. I'm much more happier. I mean, not more happier, but I feel more confident when a student is more frightened by stocks than if they're so gung ho. Oh yeah, I'm gonna make a killing. I'm gonna buy and sell, and that scares the living daylights out of me. But I just love the faces of students who you can just see the relaxation when they go, oh, it's not the end of the world. I can live through this. Assuming the world doesn't end. If the world does end, it doesn't matter where your money is. So cool. Okay. All right. I'm so proud of you. Go back over this presentation. Make sure you know the 8 indices that we highlighted that are in stock worksheet number 1. Dow Jones Industrial Average, the Dow, the S&P 500, the S&P, the NASDAQ, the Wilshire 5000, Wilshire 4500, and you remember what the real names are now. And then the Russell 2000 for small companies. And then the World Index, which is now the MSCI All Country World Index. And the EFA, which is now the MSCI All Country World Index X USA. And relax. Volatility, as we're going to see, can be our friend. Because it allows us to buy shares when they're on sale. Excellent, dear students. Oh, I'm so excited. I'm so proud of you. We're so proud of you. We're so happy and honored that you're with us. Are you getting an education? We sure hope so. Okay, because now when we come back, we are going to start doing what is often called fundamental analysis, or it's just the beginnings of stock analysis by taking a look at some of the most important and oft discussed and oft investigated measurements and statistics about individual stocks. Cool. Dear students, we are so proud of you. Thank you for being in our class. Study, and bring honor and glory to Southwestern Community College, your friends, your family, your colleagues, and to yourself.